From Gregg. If you have time in today's webinar, could you consider discussing the best practices for chasing a stock higher, particularly income method number 4? I added puts to some positions that he had recent gains on. We had a recent presentation on what's called the insurance tool on PowerOptions for locking in gains. Don't worry, we're going to take a brief look at that in a moment. One of the positions continued to rise $15 up in price. I did not roll the put along the way as I should have. Then the stock dropped to about $10 today, $5 above my current strike. If I roll the put up now, the cost will be greater than any gain I will be locking in. If I don't roll up, I'm not really getting any benefit from my existing put for at least another $5 drop. It seems critical that you continue to roll quickly on rising price. Not essentially critical, Greg, but we'll talk about that in a moment. Could you discuss the best practices in execution to chase a stock rising in price, locking in the gain to the lowest possible accumulated cost for the puts? He had a session or talked with Ernie, and he mentioned the simulation tool is helpful for analyzing the rollouts. Could you show us how to use that tool? It would be great. All right, first, what is Gregg talking about? Well, he's talking about the married put structure as discussed in the blueprint. Buying the stock and buying a far out in time in the money put option to initially control risk to only 5, 6, or 7% of the total invested. Income method number 4 is one of the 12 to 13, 13 income methods discussed in the blueprint. It's one of the 4 that deals specifically with adjusting the put option in different market situations. You can manipulate that put. It's not just a wasting asset that's giving you a floor. It is a second working asset that you can use to lock in higher gains, as Gregg mentioned, to lower the cost basis of your position, almost like averaging down but getting paid to do it, to create almost a synthetic straddle or strangle, to have protection in both directions around earnings. I have one of those on right now. And also to shorten the time frame to get to a bulletproof status. Bulletproof, of course, means no risk on the trade to the downside and still having unlimited upside. Now, as the stock moves up and I roll the put, what's happening as the stock moves up? The initial put I bought is losing in value, and I'm going to be paying a higher price to move it up. This income method is the only one that's really done at a debit, but it typically gets us closer to bulletproof status faster. Now, as I mentioned, it's always done as a debit, an increased cost in the overall position, and that comes with some of the fault we're going to discuss in a moment. But following the blueprint, the net debit should always be less than the difference in strike prices. This allows us to lock in half or maybe 40 to 50 to 60% of the unrealized gain in the stock price as it moves up. Gregg mentioned if I roll the put up now, remember the stock went up 15 and crashed $10 today, it's still $5 above his put strike price, whereas put's now out of the money. But the cost will be greater than any gain you would be locking in. That shouldn't happen, but if it is happening, because I didn't have Gregg's exact stock, there's a reason for that, and I'm going to address that, and we're going to discuss some of the other things about that too. So, as I said, I was trying to put some slides together to walk through this, but with all the other questions that came in, I didn't have a lot of time to finish that. That's perfectly fine. We'll be able to illustrate this with PowerOptions, and we will, of course, get into the other 3 questions that came in via email, and then, of course, the live questions as well. Let us go ahead then and navigate over to the PowerOptions suite of tools. And there we go. And here we're just looking at the basic trial account for PowerOptions. And, we're still at the sell warning here at a -4 setting, and we've been hitting the sell warnings recently. And we see some big drops in the tech today. ARM had that big movement down. AMD, not so big a move down. This is a position I'm in, which actually worked out really, really well for me. I wanted it to move down, and we'll take a look at why. And some other trades there. But overall, just a general malaise day. We were up a little bit in the morning, and then things started to pull back. All right, these are some of the pods that we have available on the trial that you can use for quick references, quick research, and quick analysis. To the question directly from Gregg. Now, he had mentioned this. He brought this question up. He had said some other things previous to it, that he really enjoys the presentations. He liked the one that we had a couple weeks ago referencing the stock insurance tool, where we could look to buy puts on stocks that have moved up to lock in some, if not most, of the unrealized gains. He added the puts to those positions as this was happening, and he had that one that moved up, and this is where we are. Again, I don't have a specific example, but let's talk about a few things. First, the question came in as he mentioned the simulation tool that is helpful for analyzing the rollout of options. If you could show us how to use that tool, it'd be great. All right, first off, we're going to use Trex as an example. This is actually a married put in the Fusion portfolio, but we're going to start with just the long stock position. Trex was opened on February 15th at 89.53. Stock currently closed today at 94.90, or up about 6%. It's been as high as, I think, 98 or 99. It had a sudden gap open above 100 on its earnings, but then it pulled back. But in any case, here we are at 6%. The insurance tool that Gregg initially mentioned, you can access under the signature tools or the married put tab. And this is just a simple tool where, hey, I have a gain in my stock. Quick review. I got Trex. We paid $89.53. Leave my put expiration at all months. I'll hit calculate. And as you know, we have the unrealized gain of 6%. And now it shows me various puts I could buy 42 days out, 130 days out at the different strike prices, 105, 115, 110 at the different expirations. And what would my locked in profit be? Meaning that, yes, if I have stock at 89.53, I buy the 110 put for April, deep in the money right now, but the stock is at 95. It would cost me $14.90. Because remember, the stock's up here at 95 roughly. 89.53 is my original purchase price. So my new total cost into the trade would be 104.43, but what do I have in the next 42 days? A guaranteed exit that we can force someone to buy our shares of stock at 110, so the least I could profit is 5.3%. That's guaranteed. I can make more. Let's go to the profit and loss chart for that particular example. There we see the bulletproof position. Guaranteed profit of 5.3% if the stock's trading below anytime between now and April expiration, with the unlimited upside. And yes, of course, since I own the stock, I can now apply some of those other income methods, selling a call or doing other things. Now, that's locking in the profit to the position. Part of your secondary question, Gregg, when you said, you mentioned the simulation tool is helpful for analyzing rollouts. Could you show us how to use that tool? Whether I'm tracking a stock, a married put, covered call position that we have here for one of our other questions that came in via email, as I'm tracking positions in the portfolio, we can use the Edit More Information button, go to the Position Actions, and then Position Analysis. The Position Analysis tool gives us a breakdown of our current position. My original max risk here was 5.5%. This is on the married put, of course. We had bought the July 95 at 10.95 from the stock was at 89.53. So the maximum risk is 5.48 or 5.5%. And you see, of course, here's our liquidation on the married put that we had that was opened on February 16th. 2.2% after 22 days, sort of meeting my goals in that structure. The goal when I open a married put is to find stocks I feel have the potential to move up 3 to 5% in the first 20 to 40 days. The stock's up 6%, and I'm realizing, the minimum I want to target is about 1.5% per month with this conservative strategy. So it's in my wheelhouse right now, but I actually have a different income method on it. And of course, if I hold this all the way to July expiration and do nothing, well, I'll receive the max loss because the stock's at 94.90. It's below my 95 strike. Now, here's where you see rollout opportunities. As you're tracking the positions, as I mentioned, it's a naked put, it's a covered call, married put, credit spread, debit spread. You can see the rollout opportunities for your position here. Here's just selling income method number 1. I could sell the 95 strike 42 days out, would give us $4.65 of premium. would put me, I believe, in not quite bulletproof status, but I'd have a new 6% if assigned, max return, annualized 52%, and probability. My new at risk is 0.9%. Rolling up the put up, that didn't come up yet. And the reason why it didn't come up here for rolling up the put in this case, we'll make an edit to that, is because the stock's not trading above the put strike price. That's usually the best time to do it, related to your income method number 4, Greg. I could do it here, and we're going to walk through a manual example of doing the married put. But this is the rollout opportunities that are shown. This is that analysis simulation tool Ernie was talking about. And though it's great to see things numerically, when I see any rollout opportunity, we can use the more information button here and go to simulate trade. And that'll give us a side-by-side comparison. Where does my position stand right now versus what it would be after I chose to do this adjustment, this rollout, or this income method in that case. And we see here what the new collar position would look like after selling a call compared to what the married put would look like at April expiration. So you're comparing apples to apples. That's where you're seeing a curved graph here for the married put instead of the straight hockey stick graph as well. Okay, so steps again, even if I'm just tracking the stock position, Greg, go to position actions, go to position analysis, breakdown of just my stock position. Current gain we know is 6% after 22 days. And here we have some opportunities where we could sell a call. What are the covered calls I might choose to sell in this position to reward myself for picking the right stock? Trying to get a little bit of income in to act as a small hedge on the position. Downside protection, 2.9%, 5.2% with the different strikes and the different premiums. Or here's some opportunities to convert it into a collar position by buying that far out put, different strikes, and selling near-term calls against it. And what would the new max percent if assigned be, percent if unchanged, and so on and so forth. So that's the simulation process that can be done. Now, going back here, a question came in. I'm sorry, I didn't catch the name there. It's from Ron, excuse me. And Ron says, what does the without put percent if assigned mean? I don't particularly use this one in the concept of analyzing my married puts and selling income method number 1, or sometimes another income method number 2. You'll see it without the put if assigned. Ernie likes to use this one because he was a covered call trader, been a covered call trader since the 70s, late 70s, early 80s. And to him, this view makes sense. It's saying, what is essentially the return I'm potentially making on the premium of this covered call, not including the expected remaining value of the put. Okay, so if it just had the stock here, this is just a married put, but if we just had the stock with the cost basis here of the overall position, we sold the call, 95 call for 465, assigned by itself without considering the remaining value on the put option would be a loss of 0.9%. And the 7-day out one naturally would be higher because we're only collecting $1.70, Ron, versus $4.65 for the April 95 call. At the 100 strike, we collect $2.58. So in that case, if we had that cost basis of $100.48, sold the 100 call for $2.58, we're making $2.10 or 2.1%. It is factoring in the underlying cost of the put, but not the remaining value. And how is that taken into account? Let's go back to the simulate trade one more time. So when I said this curved line at April expiration, how do we know what the returns are going to be? Well, we've got to take the Black-Scholes pricing model to calculate the theoretical worth of July 95 put if the stock is trading at the different prices on the 19th of April expiration. That's why you're not seeing a static hockey stick graph. It's curved because it's using the time sequence for the theoretical value of the put, so I can compare what would my married put potentially be at April versus what might my new collar be at the April 19th expiration. Okay, So I don't tend to use that as much, but Ernie swears by it. He loves using it, and that's how his mind works when he converted more from the covered calls to the married puts when we partnered up with Kurt back in 2008. Okay, now, no, I didn't want to do that. Let's go back to our portfolio. Let's take a look at Trex real quick. Let me clean up some of these models here. All right. Now, I want to take a look at, naturally, two things for Trex real quick. We're going to look at the married puts profit and loss chart initially. There's our married put with the 5.5% risk on the trade. All right. We know the stocks here. We know we've got our 2.2% gain on the position. Oh, I'm sorry, the stock's up here at 94.90, right near our put strike price. Yes, the break even is at 148, but that's only a July expiration. I'm going to go to the stock chart, and I have mine set up for a 3-month chart, so that's going to give us the view. And we touched upon this last week as well when I got in on the 15th of February, right about here. That's when the stock was at that 89.53. It went up here to about 95 where it is now. Huge spike at earnings. It went up to 102, but it sort of settled. It climbed back up this week to about 96, 97, and then it fell that little bit today as we saw a couple other stocks did. So we're right here at 95 at that 6.0% gain. This opening did not last as long as it could have for me to even do an adjustment after the earnings, Greg. That's why I didn't roll up the put at that time. And this is also the benchmarker because I had the 95. The best time I should have rolled it was probably up here when the stock was at 97. If I could have caught it here, I would have. Overnight, the stock had actually moved up about 20%. I think it peaked out in the overnight hours at 118 or 119. And then at the open, it was at 103 or 104, and then it just fell very quickly. You can't catch the falling knife. And I think that's probably what's happening in your position too, Greg, in the sense that the implied volatility of today with that 10-point drop in the stock was probably so high that, yes, you were selling into an inflated value on your existing put, but you were probably buying into a more inflated value with the high extrinsic due to the increase in implied volatility with the stock falling 10 points on the position, which is why you potentially saw a net debit that was greater than the difference in strike prices, which means you're actually increasing your risk with income method number 4, which usually doesn't happen. Even though this is not the prime time to do it. If we go back to the custom spread tool, the stock, sees 83 cents. The stock stayed at 95.73 today, $96. I was going to contemplate adjusting this put up to the 100 strike for July. Some of your caveats that you had mentioned in your question is that if I roll the put up now, the cost, would be greater. If I don't roll it up, I'm not really getting it. What is the best practices and execution to chase a rising stock in price, locking in gains at the lowest possible accumulated for the puts? The lowest additional debit I've ever seen is 50% of the increase in strike prices, meaning if I'm moving up 5 points, the best I usually expect to see is 250. In the scenario I'm going to mention, if I move up 10 points, the best I can expect is around 5. For me, what I look for with income method number 4 is a 60% ratio or less. What I mean by that is if I'm rolling my put up 5 points, the most I want to pay is $3. I'm going to pay $3 in debit to move the put to what? Lock in a 5-point higher payout. I'm locking in $2 of profit. At times, I usually see this at 250, and that's because typically I'll wait for the stock to be above the put strike price, almost between the two strike prices. So if I was rolling up to the 100, I might wait for the stock to be at around 97 or 97.50, and I'll get close to that 50% that I want. If it's just at 95.50 or 96, that's when you usually expect about a 55 or 60% ratio between the debit and the gain in the strike prices. So even though I'm not at where I would for this put. I could still roll it up using income method number 4. The stock's trading right at my strike price, so the time value is swelled. I want you guys to pay attention to this number. We're going to talk about that in a moment in relation to this number. And I'm going to sell to close this put. We're going to use midpoint, so it's going to be about 780. And we're going to buy this one at about 1040. Which means my debit for this transaction is going to be 260. Not probably going to get the midpoint directly, but let's just use this for an example. I'm paying an increased cost of 260, which as we saw is we had a cost basis of $100.48 or $10,048, excuse me. My increased debit of 260 puts us at $10,308. But now I'm guaranteed to get 10,000 back. My risk is dropped from 5.5% down to 3% on the position. But I did increase the cost basis, which means the break even, which I only pay attention to as a break even at expiration, 133 days away. That's irrelevant for tomorrow and for other times. All right. So that's it. I paid a debit, but the debit is always less than the difference in strike prices. In the assumption, Greg, that you're staying within the same month to expiration, if you had initially bought the March put to lock in your profit, say March 15th next week to lock in your profit, and you're looking at rolling up your put now that this decline has happened, but you're extending it by 3 or 4 months, that's a different story, and that's further described in the blueprint. That is an income method number 4, but you're adding extra time, so your debit might be greater than the difference in strike prices. But the way the options are set, same expiration cycle, the debit you pay will always be less than the difference in the strike prices, the gain in the strike prices with income method number 4. But in the situation you might experience, same thing I saw this morning here when the stock opened at 101.90, even if it was 115, 116 after hours, and then it just started to fall. Opened at 98, sprung up to 102, and then started to fall. I couldn't catch the prices. And there were times when I saw midpoint prices between two different options. I was trying to roll from the 95 up to the 105, and then again the 100, but I was trying to go for the 105. There were price variances there where the bid-ask spread on the 95 was so wide, and the 105 was more nominal, but it was still expensive due to the implied volatility shift after the earnings. I don't think I would have gotten a fill price I would have liked to be in my range, and it might have been what you saw where it was greater. But if you're looking at a further out time frame, for example, I can only go out to October, but if I increase this by 90 days and go to the 100 from the 95, remember I'm getting 780 back. It's close. Now I'm paying 1270. So here's a situation where I'm adding time, which means I'm buying into more time premium than I'm selling into, but at the same time, I'm only getting, we're paying $4.90 here, my apologies. So I'm only getting 10 cents of risk reduction from that 548 to 538. And this is possible that you saw that even though you're rolling up, you're going further out in time, Greg, that's why you're seeing the increase or a debit that was greater than the difference in strike prices. Now remember, I said I wanted you to look at this number here. Current price of our 95 put, we've been in the trade for 22 days. Midpoint is 780. Remember when I bought the put, it was at 1095. So, okay, we've lost $3.15 on our put. But the stock was at 89.53. We've gained that 6% in the stock. So we're gained, about 550, I think, 547. Okay, we've gained 547 on the stock and only lost about 315 on the put. But when I entered the initial Mary put at 1095, the 95 strike, $5.47 of that, I'm sorry, that was intrinsic value, right? The 47 cents getting us to 90, the extra 5 points. So that remaining 548 or so That's right, 548 was the risk. That was the extrinsic value or time value in the put option. One of the three core principles of why income method number 4 works and how we apply it to the income methods and the structure of the married put is the at-the-money bell curve. When I entered the trade here, the stock was around 90, and we bought the 95 put. Now the stock's at 95. This was the in-the-money put at 95. But now the stock at 95, the at-the-money bell curve, and you look at any option chain, the at-the-money option has the highest time value of all the options around it. My puts were 780. The extrinsic value actually moved up $2.40 or so, right? $2.32. We had a swelling of time premium, and that's what I'm manipulating with income method number 4. Did I lose intrinsically on the put? Did I lose money on the put? Yes. But I countered that with the stock because we have a positive delta position on the trade. So now that the stock is at or near my put strike price, I'm going to take advantage of that increase in extrinsic value following the at-the-money bell curve. I'm getting more value on my put than the initial at risk that I had, and I'm going to swap that for a lower time value now up here at the 100 or the 105. That's the subtleties. Now, your comment to have to continually roll up to get any benefit from that movement. You don't always have to consistently move it. And in the email I sent you, I told you we were going to review this a little bit, but in the email I sent you after our discussion, I pointed you to a video here. Here we are at the PowerOptions YouTube channel. You can see our recent videos here. I'm going to use the basic search for when, I think it's to stop using income method number 4. If I could spell when right, we'd be all good. Okay. When to stop managing a naked put, married puts, when to stop using income method number 4, and other concepts. Why would I stop using income method number 4? We saw that here I could have lowered my risk down to 3% by rolling up to the July 100. If the stock went above 100, I could then roll to the 105 and knock it down to 1%. If it keeps going, so on and so forth. Well, in general, what our thought is on this position here, let me clear that out and just buy the July 95 right now, or the April 95, I think I want. Yeah, 410, 430, sorry about that. This was with the insurance tool. Remember, we had a locked-in profit of 1.4%, right? So that's the guaranteed profit to the downside. As the stock keeps going up to new strike prices and new strike prices, why would I ever stop rolling the put up? Because eventually what I'm doing is what? I'm still adding to the debit each time. I'm increasing the cost basis each time. I'm getting a benefit of that by the reduction in risk. But typically, if I've been in this trade for 2 to 3 months and I've guaranteed a profit of 5%, 4 or 5%, which means I'm locked in a guaranteed profit in the worst case scenario, whatever happens next, that's averaging about 1.5 to almost 2% per month, then I might stop using it at that point. I've got a good bulletproof position. I can still do other income methods right now. I can still sell calls, do the other riskless spread trades in the blueprint. But I might want to stop at that time, stop adding to the cost basis to now just keep letting it move up and realizing more of the positive delta gain in that position. And that's what we look to do, okay? So that's what's talked about in the video. I won't go through there, but there is a way. There are times when I want to not consider using income method number 4 to stop using it, and that's discussed there in that video. Married puts, when to stop using income method number 4. So you can just look up another search that you could do. Let me clear this up. Related to this topic is just put in income method number 4. There's some other topics there as well. Pros and cons of income method number 4. Gregg, that's another one you might want to consider. Okay, yeah, so there's, I know there's some other ones, but also Another thing you can look at is the hat trick for locking in gains, which talks about using that insurance tool to lock in unrealized gains and then doing a riskless spread trade on top of that. All right, so income method number 4, very powerful to use. As you're tracking the Mary put in your portfolio, Greg, you can link to the position actions and position analysis to see potential rollout opportunities. Again, the position is not above my put strike price. The code in here is coded based on the rules in the blueprint and some other concepts, but that's why I'm not seeing income method number 4. This morning I did. When Trex opened up at 95, I was trading around 96, almost 95.80, 95.90. I saw the opportunities for income method number 4. I could see the new at risk, the new at risk per month that we saw with the other income method number 4s. And I could do those comparisons. It's great to see things numerically, remember, but then you can always go to simulate trade and see more information. There is a time when I might stop using income method number 4. You know, when you had asked something online to get any good realized gain benefit of rolling up the put, you think that you have to do it consistently. You don't have to do it consistently. In fact, you know, I had mentioned that 50 to 60% rule that I use to roll up the put option. This isn't the original position again. Sorry, let's just go back to it. But sometimes if the stock runs significantly, let's say that Trex did open at that 106 level at earnings and stayed there and went up to 110 or 115. My put might have only been worth $2. My 95 put might have only been $2. But the 115 put for July might have been 8. No, I'm sorry. Yeah, you know, I'm saying it's up to 106, 110. This might have only been $8, $9. So when there's a large run like that and your put goes deep out of the money, yeah, I'm not getting much back for it. But again, this put is around the same price that my initial one was. So in this case, what would I have done? I would have been paying about $6, $7, $8 to move up 20. So sometimes it's okay to wait if you're expecting a large move and let the stock run and then say, hey, now I'm going to roll to that 1 strike or 2 strikes in the money as if I was going to open the married put new. What put would I select? Hey, I'd be taking the 115 or the 120. I'm moving up 20 to 25 points in that case. If the stock's at 110, 112, this 115 might only run me $8 or $9. The 120 might only be $16 or $17. And I'm still getting 2 back. So I'm paying 15 to get 25. Take that every day, won't you? That's still around the 50% rule there. But if it's a large run up, you can see that from time to time you're paying much less than you're getting back here for that beyond that 50% ratio. But normally, in the normal scenarios, between 2 strike prices, between 95 or 100, or even if I want to wait for it to get to 100 to go up to maybe the 105, what I typically see, best case scenario is 50%. Paying $250 to increase by 5, that's usually the best case scenario. My goal is to be that under 33 or 60% ratio. You know what I mean? The most I'd pay for a $5 roll up is 3. The most I'd pay for a $10 roll up would be 6. If it's above that, I'm going to wait to see a better opportunity to lock in the gains. And that's, of course, all discussed in the blueprint. A lot of that's discussed in the blueprint, plus much, much more on the income method.